Hello, I'm Gavin Rochussen, Chief Executive of Polar Capital, and I, alongside my team, will be presenting the company's results. It has been a difficult period for markets, but I am pleased to say that Polar Capital has demonstrated resilience and held up very well. Assets under management recovered and rose by 749 million in the last quarter of the financial year, driven by positive market movement and continued net inflows into our new launches, specifically the Smart Energy and Emerging Market Stars funds. Net outflows from technology has steadily abated over the year, and we are seeing renewed interest in this sector. Progress has been made to diversify our distribution reach with the opening of an office in Singapore and a planned office opening in Stockholm. Digital marketing and brand efforts are yielding results, and we've received third-party recognition of our efforts, which we will detail later on. The strength of our balance sheet means that we're in a position to maintain our total annual dividend at 46p. Turning to markets, the macroeconomic environment has changed substantially, with rising interest rates in particular providing a headwind for growth-oriented funds. We've seen volatility through the year, which has made assessing direction of financial markets challenging. For example, in Q1 of 23, we saw a reversal of value-style outperformance, with technology companies outperforming the broader index by some way. Given the market backdrop, it was not surprising to see near-record net outflows across both Europe and the US in 2022. April 23, however, saw a return to positive inflows, with long-term European mutual funds garnering €9 billion of net inflows, US mutual funds and ETFs collecting about $6.5 billion. However, investors remain cautious and have favoured fixed income over equities, though an increasing number of allocators are looking for opportunities to increase exposure to equities.
Looking at fund performance, this slide shows annualised performance since inception, and the size of the bar shows performance versus benchmark, and the colour shows quartile ranking versus peers. So dark blue is first quartile, light blue second quartile, and the orange is third quartile. The strategies are ordered along the horizontal axis according to inception date, so we're seeing good performance from some of the most recently launched strategies such as EM and Asia Stars, Healthcare Discovery and Smart Energy, but also from longer tenured strategies like Biotech and Healthcare Opportunities. 3 strategies have slipped slightly behind benchmark since inception due to shorter term performance, so we're very focused on improving performance and making up ground there. Here we can see more detail on peer group rankings for our UCITS open-ended funds. The year to March 2023 was reasonably good, with 79% of assets under management in the top 2 quartiles versus peers, and the numbers are even better over 5 years and since inception. The 3-year figures are not as strong, with 65% of AUM in the top 2 quartiles. Our Global Tech Fund had a tough year in 2021, and that's pulled down the 3-year numbers a little. Here we show fund performance versus benchmark over a number of time periods. Our tech strategies play a big role here. 2020 was a very strong year, as many high-growth technology companies were big lockdown beneficiaries during COVID, but investors got somewhat over-optimistic and extrapolated these gains, so 2021 turned out to be a disappointing year versus those high expectations for the COVID winners. And then market leadership shifted towards value in early 2022. As a result, the percentage of our AUM that's outperformed over 3 and 5 years is less good than we want. But since inception, over 80% of our AUM is ahead of benchmark. Looking at total capacity, we're still pretty well placed, with total remaining capacity of roughly 40 billion sterling, so roughly twice current AUM. We take a cautious approach to capacity management in order to give fund managers the best chance of outperforming, but we still have unutilized capacity in the healthcare team, where the team continue to innovate with new strategies, in EM and Asia Stars, and in Smart Energy and Mobility, which is approaching its 2nd anniversary at Polar Capital. There's remaining capacity in the tech team, but specifically in the artificial intelligence strategy, which has a 5-year track record investing in AI tools and applications, and we're very optimistic about this strategy.
Looking at our assets under management, over the period they declined by 13% to end the financial year at £19.2 billion. The decline in assets under management and net outflows is considered modest in the context of near record industry-wide outflows and the decline in valuations of technology and related sector stocks that suffered a material de-rating in the period. Of the net £2.9 billion reduction in AUM over the year, net redemptions amounted to £1.5 billion, fund closures were £500 million, and market decline and performance accounted for £900 million. It's notable, though, that in the last quarter of the financial year, AUM increased by £749 million, representing a 4% increase in the quarter. More recently, to the 16th of June, assets have recovered to 19.9 billion, which is above the average figure for the financial year of 19.6 billion. Polar Capital was not immune to the selling pressure witnessed across the industry, particularly in the active equity products, but we held up well given the backdrop and bear markets impacting our larger strategies. Of the total net outflows of 1.5 billion, the technology strategies accounted for 1.2. UK and European equities remained out of favour with investors, and this was reflected in outflows from our UK Value Opportunities Fund, which was largely one client, and from the Melchior European Opportunities Fund. We saw inflows into 9 other of our funds, most notably biotechnology, emerging market stars, and smart energy. Our US distribution team continues to gain traction, raising £107 million for our emerging market stars strategy. Net inflows into our EM stars, sustainable thematic, European income and healthcare strategies have continued into the current financial year. Looking specifically at our technology strategies, while the total net outflows from these strategies were 1.2 billion, the rate of these outflows slowed quarter on quarter, and in the final quarter were 237 million. This net profile should be considered in the context of equivalent net outflows of 1.3 billion in the 2022 financial year and net inflows of 1.8 billion in the 2021 financial year, the year that benefited from the so-called COVID-19 winners.
Our 2023 financial year coincided with a difficult period for equity markets in general. Underlying the results is the 14% decrease in our average AUM over the year to 19.6 billion. This in turn translated into net management fee revenues for the year of 154.8 million. Our net management fee yield over the year measured 79 basis points. The decrease is a result of a changing product mix due to a rebalancing of the technology strategy and the rest of the business, as assets raised in newer strategies arrive at seed margin rates. Our longer-term guidance on fee margins reducing by at least 1 to 2 basis points each year remains. Looking at the key components of our profitability, the lower average AUM base meant core operating profits declined to 47.9 million, resulting in a core operating margin of 31%. The challenging market environment meant that performance fee profits this year were 1.7 million. Other income represents the profits and losses recognized on our seed portfolio net of hedging costs and interest income on bank balances. Tying everything together, profits before tax amounted to 45.2 million, which are down 27% on the prior year, and this translated into an adjusted diluted total EPS of 44.3p, which is a 21% decrease. Total operating costs for the year were 118.9 million, which is a 16% decrease on the prior year. As the chart on the right illustrates, this decrease is driven mainly by lower variable staff compensation cost. Other operating costs increased marginally as research and travel costs tracked back to pre-COVID levels. Exceptional costs are items that are either non-recurring or non-cash and therefore excluded in determining adjusted diluted EPS. Within this line are 5 million of termination and reorganisation costs, which include all legal costs associated with the FPA settlement, closure of the Phaeacian legal entities, and subscale Dalton funds. The annual amortization of intangibles amounted to a further 1.2 million. The total cash and seed portfolio holdings of 151 million at year-end demonstrated the strength of our balance sheet. Our seeding program supported 7 funds at the end of the year, with the seed money in the Smart Energy Fund being redeemed post-year-end once that fund grew to 100 million in size. To preserve group capital, seed investments are hedged for market and currency exposures. The capital position of the group remains strong. The bar chart on the left shows how allocation of capital across seed investments, regulatory capital, and general working capital remains broadly consistent with the prior year. The overall surplus capital of 57.7 million over regulatory requirements remains a healthy one. And finally, the framework applied for the use of capital remains unchanged as we look to balance returns to shareholders with strengthening and growing the business. Given the strength of our balance sheet and our confidence in the outlook for the business, we have announced a second interim dividend of 32p, which means the total annual dividend has been maintained at 46p per share.
Our stated strategic objective over the past few years has been growth with diversification. By diversification, we mean by product, by region, and by channel. In terms of our AUM, good progress has been made to both grow our AUM and to diversify our asset base. As you can see, our 5 largest strategies account for 81% of our AUM, which has fallen from 90% in 2020. Our percentage exposure to technology strategies has declined as other products have achieved scale. Tech peaked at 56% of AUM in 2020 and now represents 37%. Looking at our 5 largest strategies, you can see strong annual growth rates across all 5, with emerging market stars the fastest growing, albeit from a low base, as this strategy was launched in summer 2018. The flows into emerging market stars is a consequence of gaining market share, as flows into emerging markets generally in this period have been negative. Despite recent outflows, as you can see, the Global Technology Fund has seen double-digit annual growth in AUM over the period. As well as launching a number of new funds, which remains a key part of our growth strategy, we have been diligent to close products which are no longer commercially viable. Product rationalisation is important in terms of cost control, but also keeping the focus of the business on growth areas. Looking ahead, we have plans to launch an emerging market ex-China version of our EM Star strategy in both US mutual fund structure and European UCITS. There is a growing demand for allocators to be able to control their exposure to China, given how large a component of the EM universe it is. Earlier this year, we saw a well-publicised breakthrough within the field of artificial intelligence, which our technology team are particularly excited about. Artificial intelligence has been a key theme within our technology portfolios for some time, and in fact we launched a dedicated fund nearly 6 years ago. Given the breakthrough, perhaps unsurprisingly, we have seen renewed interest in our technology strategies.
Our distribution strategy remains growth with diversification by product, client segment and geography. By successfully combining our sales and digital marketing capabilities, we can extend the reach of our distribution to accelerate growth. We've established distribution platforms and deep client relationships in the UK, continental Europe and the Nordic region. We continue to extend our reach in the US and Southeast Asia. We recently established a distribution office in Singapore to support our clients in the region and to drive business development in Japan and Australia. Our approach to global expansion remains both targeted and measured. Polar Capital is a client-focused organisation. We aim to deliver differentiated, specialist investment offerings to our clients with exceptional service and support, including the provision of timely and accurate investment insights, both in person and digitally. Pleasingly, and testament to our approach, we scored well in the latest annual Broadridge Fund Brand 50 survey of investment professionals. Within the UK, we were ranked 3rd for sales and account management, 2nd for client-oriented thinking, and we retained our number 1 ranking for thematic equity. Overall, we were the 7th highest ranked brand in the UK, up from 8th the prior year, the smallest group in the top 10 based on AUM, and in the company of much larger peers. Client communication and engagement is fast becoming a point of differentiation and a way for smaller asset management firms to compete with larger groups beyond simply price and investment performance. We continue to invest in our digital marketing capabilities, aiming to further enhance and expand the way in which we engage and communicate with our clients. Our goal is to configure and optimise our client services and marketing so that it's increasingly tailored to specific client segments and geographies. We are pleased to receive third-party recognition of our progress. In the same Broadridge survey, Polar Capital is now ranked 6th in the UK for marketing and communications, rising from 17th in 2019.
In summary, it has been a steady year for Polar Capital. Following a volatile period, our current AUM is above the average for financial year 23. The growth with diversification strategy is yielding results in both distribution and across our product range, and we continue to search for differentiated teams with track records managing complementary strategies, which we can add to our business over time. ESG remains a focus, and we've increased our centralised resource in this area, and the majority of our eligible funds are now classified as either Article 8 or Article 9. Significant capacity remains in funds which are currently receiving net inflows. Our strong balance sheet puts us in a position of strength and enables us to maintain our dividend. Markets may remain uncertain in the near term, but in our view, Polar Capital is well positioned with its diverse range of specialist investment strategies. I hope you found this interesting, and thank you for taking the time to watch.